financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rahaim.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com.
Welcome to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Rahaim. Hi.
Hi, Jess. How are you?
How many panic calls have you been getting recently?
I tell you, well, not too many panic calls.
That surprises me.
Well, I tend to have people in safer things usually, right? But a little bit more conservative or balanced. But I did get a message from one or two people even asking me if their money was safe in the bank. So what I'm seeing is that people are paying attention to the news and the market right now. The last 3 days, I should say that we pre-record this show. This is a Tuesday, April 8th, when we're recording this show. So if you see any ticker symbols or anything at the bottom, it's from April 8th. And before we did the show, probably. So what I will say is that people who never watch the markets, who don't pay that much attention to the news, are thrown into the mix right now because they're worried about their 401ks. The average person, right, is who I'm talking to, worried about their 401ks. So what's very difficult about that is they often don't have a real frame of reference, some familiarity with how to interpret what's going on in the market. And so they panic more easily, but they act more slowly. They don't know what to do.
Okay.
That's an uncomfortable position for people. Now, as you know, I try not to be political on this show. I don't think my politics have anything to do with somebody else's decision. But I don't think I'm alone in saying that the market requires competency and consistency. And if it gets those two things, that equals confidence. So I will call those the 3 C's. Competency and consistency equal confidence. When the market doesn't have those things, it gets the 4th C, chaos. And
that seems exactly where we are. I'm hearing a lot of terms thrown around like that I've learned from this show, like bear market and recession and things we've kind of hit on a little bit before. But yeah, I think everybody probably really needs to hear this stuff right now.
Yeah, well, the thing is, we hit a bear market in 3 days. We hit bear market territory. We haven't done that since 1987, and we did it in 3 days.
Wow.
I'm not saying that like it's a great accomplishment. Okay.
We're not
and I'm
sorry to do that yet.
Sorry to be laughing at all because it is not funny to be in this position. But you have to understand that what's happening to most people right now is what we call whipsaw, right? Panic, oh my gosh, look at my 401k going down, or I'm afraid to open the envelope. Followed by, hey, wait, we're getting some gains. Let's be clear that what we've got at the time we're recording this show are not gains. They are losses we're starting to get back some of. But
I feel like the people that I've talked to, the people that are in their 50s and 60s are the ones that are really worried versus 20s, you'll make it back as we talk about. But if you're getting ready to retire and then you look at your statement and it's just demolished, it's hard to not panic.
Yes, I heard a statement from the president actually that said people looking to retire right now aren't worried about the day-to-day fluctuation. I'm paraphrasing.
I saw that as well. Yeah.
Oh my goodness. Tell that
not
to
the people
somebody.
I'm talking to. Yeah, not the people I'm talking to.
No, I mean, just think about it. Would you be worried about the day-to-day fluctuation if you're knocking on retirement's door? Yeah, you would. Because if you cash out of those accounts when you have those losses, they are no longer paper losses. They are now real losses, and you need that money. You've relied on that money to retire, which is another reason why we talk about, as you're getting closer to retirement, you need to start moving money into more conservative areas. Bonds, if you're working with a broker, I use a lot of fixed indexed annuities to accomplish that. Sometimes people go to high yield savings accounts, things like that.
Can I take a quiz here? That means divestment is what I've learned from you.
Diversity. Yeah, and
Diversity,
divestment, right.
divesting. Yes.
Yes, if you're unwinding your investment portfolio, you might call it divesting. Exactly, right. So where things get really sticky right now is that we don't have any consistency. One day
Hmm.
it's, I'm going to slap these tariffs on. The next day it's, I might negotiate, right?
Hmm.
But
Yeah.
maybe I'll do 50% on China, who will have no real choice if they're going to protect their economy, but to retaliate. And then we say,
And
but
they've
don't
come back,
retaliate.
yeah, and they've come back strongly and said they're doing this. So
Boy,
it day to day, it's actually not day to day, it's minute to minute. So you're right, it's hard to act in that kind of an environment.
lest I remind people that China, if they ever call our notes, we are
Mm.
in trouble. Okay. So America has had a history of setting the financial pace for the world. When we start to withdraw from a world market, as the rhetoric has been lately, that creates more of what you see in the world markets. It isn't just that the US economy tanked over a three day period. Hong Kong had the worst drop that they've had. They dropped
Hmm.
13%. They haven't done that in decades. Let me just go back for a moment because we did a show about tariffs. Uh,
Hmm.
Little did I know that they were going to be levied in a day or two after I said that, but we did the show about tariffs. And the point I was trying to make is that tariffs are a tax that we pay on products.
Hmm.
The idea is we're going to slap a tariff on these countries and they will fall to their knees because they're going to have to pay so much money. It's not quite how that works,
Hmm.
right? Who's going, okay, you slap a 50% tariff on China. How much are you going to pay for your next computer if it's made in China or if all the parts are made in China? It isn't
Hmm.
China paying it, it's us paying it, right? It's the consumer that has to tolerate that. So that brings me to my main concern here, which is who gets hurt. Who gets hurt by this are the working class.
I was just looking today, and you probably know all about this. And if I'm getting it wrong, please tell me. But I was seeing too that there's a loophole now also being closed where if you're buying stuff, it used to be under $800, you could get it without all these tariffs and taxes on it. Now they're closing that. So if you're ordering, just say Shein or Temu or any of those places, probably have the names, the Temu pronunciation wrong, but it could be up to $50 an item. They're adding all these taxes on. So where you could still order under 800, you can't anymore.
I think you have it right.
Okay.
And I think even the pronunciation of Timu was right.
Okay.
Uh, it brings up an important point. The working class will get hurt, right?
Hmm.
The average family of four can expect to pay about $3,800 more a year. That's if we're not buying a car. I mean, we talked about that, right? How much a
Yeah.
car is going up. But just your average, day-to-day groceries, whatever you're going to do for your regular living expenses. Because of the tariffs that are coming in, the average family of four is estimated to have an increased expense of about $3,800 a year.
Mm.
Now, who gets hurt really hard? The people who can least afford it. The
Right.
low income families. Those are the families that shop more on Temu, that shop more in, they buy more imports, right?
Hmm.
They're looking for a deal and they don't have the cash to say, I don't care, I'm not shopping there. I'm going to shop at my mom and pop store down the street. They have to really watch their pennies. And that sometimes means, most often means that lower income families buy more imported goods.
We'd all love to support local and like your local bookstore or whatever else, but in reality, we get a lot of products from the Walmarts and the Targets and the things that, I mean, that's just how you make it week to week or month to month
That's
for a
right.
lot of families.
Even people who don't think they're buying imports are buying imported goods.
Hmm. Yeah.
We don't make a lot of things here. One of the politicians who will remain nameless at the moment came out and said, millions of jobs are going to flock to the United States to put those little tiny screws in iPhones.
Hmm.
Okay, it's not going to happen. We don't work for $2 an hour. And if we have to pay Americans to do those jobs, we can't afford the product in the end.
Right.
So, to go back to lower income families for a moment, if a family of four middle income is going to pay about $3,800 more a year, if these tariffs stay on for a year, another thing we don't know, then lower income families will see 2 to 2.5 times that burden. That means their purchasing power was just reduced. It was just cut by that amount. So this will hit lower income families especially hard.
It feels also like it's a double whammy. You're also then combining it with the federal cuts to like food programs and other resources that you might have availed yourself to before. So not only do you not have those, you also have 3,800 more.
I don't think there's any way to see it differently. I know that people will say, well, it's short-term gain for long-term, short-term pain for long-term gain.
Right.
I don't know. When you're ticking off the world economy like this, even if you get your way temporarily, and
Mm-hmm.
maybe in the end I'll be wrong about this, right? How long do you think that's going to last when you've angered everybody? Remember when we
Right.
were talking about tariffs, I said to you, I don't think we should tick off Canada and Mexico, right? Just on car prices alone.
Mm-hmm.
But I know that there are people who believe, and everybody, that's what America is supposed to be, is that everybody is welcome to their opinion, right? I know that there are people who will see it as he's just negotiating a deal. He's going to press hard and they're going to bend to his will and we're going to be better because of it.
Mm-hmm.
That remains to be seen. But right now, I'm looking at a lot of people very worried about their 401ks, asking, what are we going to do to move to safety and things of that nature. And I think you're right. The cutbacks and let's not forget the job losses,
Mm-hmm.
enter Doge, right? We're hurting our economy. And the sad part about this is when it happened because of COVID, we had to scramble and deal with it, right? Politicians were spending their 24 hours a day trying to figure out how to save us from this. Right
Mm-hmm.
now, we have a self-inflicted problem.
It's also interesting too because obviously I cover the news and I'm reading a lot about it, but there are a lot of financial people in the financial world that are backers, Republican backers, that are breaking from this and saying, I'm looking at this and I'm not really seeing any way it's not bad.
Yeah.
So that's interesting to me too. That I think makes people a little bit more nervous too.
Well, that's why I said, maybe I'm wrong, but I don't see any other way to see this. I mean, you're saying it back to me, and we did not talk about this before the show.
Mm-hmm.
What are these families going to do who are experiencing cuts, job losses, increased expenses, and complete uncertainty about whatever savings they may have? This is not a comfortable place for people to be as an investor. You can't make decisions based on this stuff.
So I'm hoping that you have some tips maybe to
I
kind
do.
of calm the waters right now. We'll get to those in the second half, but in the meantime, I do want to get your phone number.
Of course, it's 413-773-3333.
And you can go to hugyourmoney.com. We'll be back with part two of Financial Fitness with the Money Doctor, Dr. Francis Rahaim, right here on WHMP.
Financial Fitness with the Money Doctor is underwritten by Franklin County Technical School. We build futures. Visit fcts.us or call 413-863-9561.
Welcome back to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Rahaim. We're talking about kind of a difficult topic today, but one that's on everybody's minds that I'm talking to.
There's no way I couldn't talk about it today. Now, by the
Mm-hmm.
time people see this show, you need to remember that we filmed it on April 8th, and my
Mm-hmm.
guess is there will be something very different, whatever that
Right.
might be. And
Something new. Yeah.
that's the point, is we cannot, as advisors, right? People are not making the same decisions. They're not making the decisions the same way that we're trained to make them, which is pay attention to whether you're going into a bear market or into a bull market. And, are your clients close to retirement? Are they not? How is their portfolio diversified? What sectors seem to be doing well in the market? You know, we don't have any clue right now. I mean, I'm going to say that I do have some tips for people about some things you can do that may be useful, of
Mm-hmm.
course,
Yeah.
right? But I think every advisor I know is just saying, I'm just glued to the television and I'm exhausted watching it because I can't find a direction. We were in a bear market for like a minute. We like,
Mm-hmm.
bingo, bear market. Worst 3 days since 1987. We haven't been there, right? And then the next day, oh, look, here's the market coming back. Why? Now, here's my really personal theory about why this might be happening. And believe me, I am going way out on a limb here
Okay.
because I
Okay.
haven't heard anybody else say this. But, the one thing that I can hold true to all the time is that the market likes certainty. You've heard me say it when an election is coming up or when there's a crisis. As soon as the market has some certainty, it likes it. Now, what you're seeing today with some gains coming back is that there's been a little pullback from the Trump administration to say, uh, well, instead of just saying, we're not going to talk, here's your tariffs, here's your pill, swallow it. Now
Hmm.
they're starting to say, well, we might talk about this, we might negotiate about this. And when people are saying, are these permanent or temporary tariffs, we get the double talk, the double speak of, well, they could be temporary or they could be permanent. I mean,
Hmm.
President Trump may be trying to keep, everybody in a foreign country on edge, but while he's doing that, he's keeping us on edge as well. So my personal theory, as I was getting to, about why the market might be tolerating this
Hmm.
better than we expected it to. Boy, I'm careful about that. But for the moment, is that in some crazy way, the sort of uncertainty has become more normal. So, in
Hmm.
some way, we're becoming desensitized to the uncertainty. It's not such a surprise when the Trump administration flips on a dime and says, well, now we're going to do this. Or we're going to go from, I'm going to double down to, no way, I'll negotiate in
Hmm.
24 hours. I, I do hear people speaking angrily about, you know, uh, Nero fiddled while Rome burned, right? Playing golf and doing those kinds of things while the market is tanking. And
Hmm.
just, I'm having parties with billionaires, and I had to wonder, what are the conversations with the billionaires? Are they shorting the market? I don't know. Um, so that stuff is hard, and it is difficult to not feel political about it, even though I am sensitive to both sides of this. The side of harming the American public, I don't see where that has a place in politics. You're supposed to be working for us, right? That's what government does. And in the end, if this turns out to be a great thing, I'll swallow my pride and say, boy, I was wrong. But
I
right
was going to
now,
say this is, yeah,
working for
this is one of
people.
those times where you'd be happy to be wrong. But
I
talking
would.
about not being on either side, it's not just Democrats or Republicans that are losing money. It's everyone. It's going to be more
That's right.
expensive for everyone. So for me, just like you, it's not about whether you agree or don't agree with the majority of the administration. It's like it's hurting everyone, and it's hard to see. Like you were talking about in the first half, a little bit of pain now. Okay, well, how long is that pain going to last? And especially if you're near retirement age, can you afford to hang in there for however long?
Well, that's a very interesting question because there are estimates floated already by people who do this for a living, right? Analyze politics for a living and analyze the economy, and it seems to be about a year. People
Mm,
seem to say that the American public will tolerate at least I shouldn't say the American public. The stat I've heard is that the backers, Trump's backers, his base,
hmm.
will tolerate this for about a year. A year is
Mm,
way longer than I would like to see anybody have to tolerate this. There will be people who will be flat broke, homeless, hungry
yeah,
in a year. I mean, in way less than a year. Most people today don't have more than a week or two in savings. If they have a few months, they consider themselves lucky. And
right.
sometimes that savings is in their 401ks, and they're thinking, well, I can borrow against my 401k if I need to. And they're watching it go down. So,
Hmm.
yeah, so I did say that I would have some things that you can do, but I just want to say that the quote about don't be a panikin, right? A coined word, panikin. The markets move rapidly on something we call fear index. So I'm not surprised that the president would come out and say, don't panic, right?
Hmm.
Because the markets were already moving drastically over the weekend. I was
Hmm.
not looking forward to waking up Monday morning and looking at what the world markets were doing before ours opened. But you have to remember that that fear index can be very dangerous. And one of the places it can be the most dangerous is for the people we're talking about in the beginning of the show, which are the people that don't have their finger on the pulse of the market. They're maybe not large investors. They probably have some CDs, some savings accounts, a checking account. Maybe they've got a mutual fund or two. And they're wondering, should I pull my money out of the bank because
Hmm.
because there's a threat that FDIC will be dismantled. And
Mm.
so I want to say you want to be very, very careful about that. If you ever saw It's a Wonderful Life, you know what a run on a bank is, all right?
Hmm.
You don't want to create a run on the banks because you're afraid, all right? What you want to do is pay attention to what's happening. Even if the FDIC was dismantled and privately held, that doesn't mean that your money would not be safe. It might. I don't want to see the FDIC dismantled, believe me. But just pay attention to what is real, not what your gut tells you, and really do lean into the news like this. And if you only look at it when you're worried, it's kind of like making a budget when you have no job, right?
Hmm.
You have to kind of learn about the stuff as time goes on. There's one other thing I wanted to talk about before I give you some real solutions here and it's the comment that, well, only 50% of Americans have money in the stock market, so we don't really care.
Hmm.
Well, first of all, 50% of Americans, a
There's
lot
a
of
lot of people.
Americans.
Yeah.
I mean, holy cow, if that were accurate. But I'm going to say it's way higher than that because anybody with a 401k, unless they're completely in the fixed account, which is
Hmm.
almost nobody, has stocks. They have mutual funds. Mutual funds are made up of stocks.
Hmm.
Okay, they have money in the market. So if you own a mutual fund or you own some bonds or you own some stocks directly, you've got money in the market. Now, I told you that I would say a few things that people could think of. Um, and again, because this is changing all the time, I don't know. But what I'm thinking is, first of all, money in the bank is probably safer than money in the market right now. Will you give up some gains? You might. If the market
Hmm.
bounces back and you have gains, that's your trade-off, right? If you, and I want to preface this by saying I'm not giving anybody advice here. This is an educational show about that,
Hmm.
right? So that you
Yeah.
can ask your advisor these things. Would I be better off if I moved some of my money into safety? And you can do that within your 401k, usually online with a click of a button, slide some money over there, right? You need to be aware that if you're going to sell shares in your 401k, if you're going to move money, it's not going to happen till the close of business that day. So don't wake up in the morning and say, I don't like the way the market is and push the button
Hmm.
without talking to your advisor. Okay. The second thing you can do is, certainly you could do it in a bank. You could do some CDs. There are decent rates on CDs right now. It's pretty short-term commitment. And you could also do high yield savings accounts or money markets, all safer kinds of money, not really linked to the bank, to the market, right? They give you a fixed rate of interest. This is what you're
Hmm.
going to earn for this period of time. And then the last thing I'm going to tell you that I like to see people do is to pick up some indexed annuity dollars, right? To put some money into indexed annuities because there you have a sort of a blend. You have the safe money because they usually have a guaranteed floor, right? Your principal is guaranteed plus, in some cases, a minimum interest rate guarantee. Um, and you have earnings linked to the market. So you could have some money. This isn't for all of your money any more than anything is, but you could have some of your money in something like an indexed annuity, which would give you the safety you're seeking right now
Hmm.
backed by the strength of the insurance company and then the guarantee funds in whatever state you're in that you purchase it in. And then on top of that, if the market does rebound and goes up, you will get some of those market gains. Now, could you out earn it in your stocks or your mutual funds if you stayed there? Maybe. You could also
But
out lose it.
I was going to say you could also tank it. Yeah.
Yeah. So especially when you're getting close to retirement, that might be a good, plus you could get a lifetime income, at some point in the future from it. That would
Hmm.
be reliable. So.
This might be a big question, but what happens if the FDIC was dismantled?
Well, it's already been hit a bit. But what happens if it's completely dismantled? I think the idea is that it would be privatized. And so in some way, private agencies would then insure your money.
Hmm.
Um,
But if you already have money in the bank, would they kind of take over for the FDIC?
well, it's a good question. I mean, we don't have any history of this. That's the
Yeah.
thinking. That's the thinking. But do you really want that? I mean, privatizing government is one thing. There are a lot of people who believe that privatizing government has its merit, right? But
Hmm.
when it comes to a contract that you created with a bank when you put your money in there and said, I'm going to put my money here because, It's FDIC insured and maybe insured beyond that, SDIF, right? So I'm going to agree to put my money here because that's appealing to me.
Yeah.
When you start to remove that sort of guarantee or even privatize it, you'll hurt the banks as well because people won't have a reason. If you're going to take on risk, you want it to be because you have a chance for higher earnings, right? So if you want safety and you're going to put your money in the bank and they take away the safety feature, what's the point?
I'm also hearing that some people are buying gold.
So people will always make decisions like that. Like, where is my money going to be safe? Am I going to buy gold? Well, what's the price of it? What do you think it will go to? I mean, that's like anything else. You can say it's a metal, and so it has an intrinsic value, and you would be right in thinking that, but you have to be able to sell it to someone who has money to buy it
True.
if you're going to convert it to food.
Every morning when you get up to kind of take a look at what it's doing at that point. And I could imagine as an advisor, it's got to be hard what direction to point your clients in.
Well, yeah. I work as more of a consumer advocate than an advisor at this stage, right? So what I'm doing is bringing news to you and saying, this is what's going on, teaching you to think about it a different way, maybe, or to maybe hold up the mirror and say, this is what I think you might want to consider. And then talk about what are your options. You know, you don't have to do them with me, right? You can do them with your advisor or by yourself or whatever you want, but you should have a place, a safe place that you can go to where you can get information like this that is not necessarily selling you a product, right? I'm not,
Right.
nothing about this show that is saying you have to buy these things, right? Might you buy something through us if you decide to work with us? Yeah, you might, but it's not the basis of the show, right? So I just, I think that people are really, I mean, we could go on forever about this, but people are really worried. I don't think it will I don't think the market will settle down very much. I think it's been choppy and it's getting choppier as we move along, unless something happens, unless there's litigation that says you can't put tariffs on. There's seven, as of yesterday, I think there were seven Republicans that had signed on to that bill. The House would be tougher, but there's a bill about the president needs Congress before he can put tariffs on. If that passes, that could settle the market down a bit. Maybe, right? That's a little certainty. Then there's some certainty about something. But, what are people doing right now? They're sticking their head in the sand. They're doing things like Megabucks in the middle of all this has raised a ticket to $5.
Oh, wow.
And I see these ads for Jack Pocket where you can scratch tickets on your
Oh,
phone.
no. Yeah, that's
I'm
just
getting
what we
bombarded.
need.
Yeah, I'm getting bombarded with work from home, So just be cautious about your money. Don't lash out into some get rich quick scheme because you're worried and you say, well, I might as well do whatever. Get some professional help and make thoughtful, prudent decisions. And you can do it pretty easily, I think, if you reach out to advisors.
And what is your phone number if someone wants to reach out to ask you some questions about this or
Sure, they
anything,
can.
really?
Yes, they can reach us at 413-773-3333.
And you can go to hugyourmoney.com. We'll be back again next week with another edition of Financial Fitness with the Money Doctor, Dr. Francis Rahaim on WHMP. Thank you.
Thanks, Jess.